coming into the beginning of August, we started to see potential highs in the marketplace. In fact, I'd said this on a few occasions that we came into July. And if I can show you right here, we were talking about coming through the 550 target that we were looking at. Remember, we were talking about 550 to 580. We got up into this area here, and then we had a little bit of a pullback. And we broke through a very crucial trend line. And we thought, you know what, we might trade back to that trend line, but the probabilities of going up to 580 during this session between now and really election day look to be lower. Well, that was confirmed as the month of August saw its highs on the very first day above 550. And within a matter of about 3 days, we took about 10%, took about a 10% haircut off the SPY and the S&P 500 in a matter of days. We've seen a bit of a rally since then, and that's expected because when you get a big sell-off like this, we do tend to see a rally. Now, will that rally last? That's where we've got to take a little bit harder look into what's going on in the markets. And so I want to take you into, see support down here just below 500, and I think 500 is a good round number support. We'll see whether that gets targeted, but take a look at what else is happening, because when we take bonds, when we take currency, when we take commodities, and we put those together, it helps give us either confirmations that everybody sees the market going in the same direction. And when I say everybody, I'm talking about smart people. Or are we going in different directions? Let's see. Look at the bond market. The bond market has flipped, meaning that last month we saw downtrends in the market. All right, last month, an entire year, we've seen a downtrend in the market. Well, we saw some bottoms in May. We really went a bit sideways to slightly higher in June. We broke out at the end of July, and the bond market flipped. And what that means is that now, especially the last couple of months, bonds have become a safe haven. Right? We do expect pullbacks, and they've already started. I mean, bonds, the TLT index went from the low 90s to hit 100 earlier this week. We've seen the pullback happening. And this is the area now which was resistance right below 95. Let's call that 94. We see 94 being support. Right? So it's possible we could get this pullback and then move higher. What could push the bonds to move higher? Interest rate cuts will make this chart move higher. Now, you might think interest rate cuts are good for the stock market. Eventually they are, but what interest rate cuts also tell us is that the economy is pulling back, and the Fed wants to keep the consumer-driven market that we have from turning into an all-out recession. Okay? We'll get to this a little bit more, but the bond market is telling us that potentially the stock market could see, at the very least, more sideways action for at least the coming month. Take a look at the US dollar. This is UEUP. This is the double dollar index. It is still showing bullishness, meaning that what we see is we see these higher highs. We've had a substantial pullback. So the US dollar's pulled back about 46% from the January lows to the June highs. Now, it has gotten a little bit of legs here in the last couple of days. It's got above support. I've got two scenarios here with the US dollar. If the market breaks down, the US dollar, there's going to be money that's going to flow into dollars. That's called a risk-off position. If interest rates are cut, then we could see the US dollar come down. Here's an interesting question. Could both scenarios occur right after the other? Yeah, absolutely. We could see the market break down. We could see the US dollar. We see people come in as a safe haven, and then the Fed makes a quick decision to cut interest rates, and that could flip the US dollar. So there's a chance, there's an off chance that both of these scenarios could happen before Election Day. USO, okay, this should be no surprise to any of us here. We've been talking about oil. We talked about that coming into July, the bullishness, at least seasonally, was going to cease. And since then, oil has been in a 10-point trading range. We've seen oil now go from 82.50 in July to now we've gone down around 72.50. We're in a 10-point range right now. We've been in a 10-point range since February. Right. In February, we were down in the low 70s. We ran up to the low 80s. We came back down in June to the low 70s. And in July, in the month of June, we ran from the low 70s to the low 80s. We're back down again. Right. My expectation is that the trends, the seasonality would break this lower and would break it down below 71, where if we do get an escalation of war, and there's 3 hotspots right now that I can think of globally that could cause oil to rotate and go higher. But 2 out of 3, 66% chance right now that oil continues to move lower. All right. Let's talk about gold. So gold's best days as jumping right now, and I'm going to say this for the next month, are behind us. That March, April, May area is where we really just exploded in gold and GLD. Since then, we have been getting higher lows and higher highs. I expect the next swing is going to be lower, and we've seen that already happening. And those of you that follow us at Stock Cycle Trader, one of our trades is short the junior miners. And so that's part of an entire bearishness that's happening in the metals and mining index, right? And so for the next 30 days, we expect to see sideways to down. Gold trends, however, long-term trends are up. So again, it is possible we see the pullback, but the pullback ends sometime in September, and we expect to see this rotate back around and get higher. Now, let's talk about these last 2 charts before I bring on my special guest for the month. You remember July? Remember I was talking about the VIX, and we went back and we looked at the last couple of years, and we saw the VIX high at 22 and the VIX low was down below 13. And then earlier this year, we saw 13 become 21 and came right back down to 12. And I said, this is the chart to worry about. I said this last month, and that when the VIX is low, it's time to go. And it was setting up for something, even short term, to possibly move back up into the 20s. I did not expect us to see a Japanese market that was down 13% on Monday. I did not expect to see the NASDAQ going down 6.5% on Monday. Unbelievable, right? So that's what we see. And so, as you move along here, look at the chart. Here's the VIX. This is those 13 to 22 moves. Here's that recent one. Why is it so far down here? Because of what happened on Monday. You see that big move on Monday, and the VIX hit a high of 65. That was the day session. If those of you, how many of you look at the overnight sessions? Because if you looked at the overnight session, you would have seen the VIX in the 80s coming into Monday morning. That's how bad it got. Okay. And so from there, you see that pullback again, and we have pulled back down, but 2771 is still high for a VIX that we're used to seeing in between the mid-20s to the low teens. All right, so what caused the Monday market meltdown? Well, this market, and you guys all know this, it's been very resilient this year. We've had political drama, and I think that's really kind of the most recent stuff. But if you take a look at the trends, I'll get back to political trends. 7 stocks have basically controlled the rally, and 7 stocks over the last month have controlled the sell-off too, and it just rotated into everything else. The economy is saying recession. We're getting the warning signals, recession, and it might be a small one, but consumers are pulling back spending. I mean, my wife and I went out recently. We don't go out that much, but we went out last week, and we went to a nice restaurant. And the chicken dinner. My wife likes chicken. I'm kind of steak and seafood guy. My wife likes chicken, and the chicken dinner was $50. $50 for chicken. I mean, it tells me that at least in some of these restaurants, and you're seeing more and more Chapter 11s happening in the restaurant industry, and it's because the consumer is basically saying, I can't spend that kind of money anymore. And that's starting to spill over into other areas. Now, you got global uncertainty. Wars are continuing, and that's going to expand, possibly expand, and that's going to cause more instability in the market. But more recently, the political drama that's happened in the last month has been and I've never seen so much news come out politically in such a short period of time. And so now what you've got is you got two candidates. You got drill baby drill, and you've got Green New Deal. Let's just say it this way: drill baby drill on the right, and New Green Deal on the left. And so the Dems have been surging in the polls recently for a number of reasons, but and I expect that that's going to mean revert, and this is going to be a very, very close race as we come into November elections. You know, it was last month everyone had said that the Dems had thrown the towel in, that Trump's going to be our next president again. That's not the news anymore. You know, and do you look at news? Well, it depends on what channel you look at. But if you look at polls, and you look at several different polls, everything looks like it's going to shift back to a very, very tight race. We'll see where this transpires as time goes on. But Monday's market meltdown wasn't one of these. It was the conversion. It was the markets looking at all four and saying, okay, there's a situation here. And you saw a lot of money move to the sidelines.